What's happened?
Colonel Julian called. He's the chief constable of the county. He's been asked by the police to go to the mortuary. He wanted to know if I could possibly have made a mistake about that other body.
If you love listening to this show, please consider giving a rating and a review on Amazon Alexa or wherever you listen. We want to continue bringing you this amazing content, and part of our ability to do that means that we need a big audience. Now, it may not seem like much, but rating and reviewing the show will help more people find us, just like how you found this show. Simply on any podcast platform, search for a show, scroll down to the bottom, and push 5 stars. It's that easy. Thanks for supporting the show. So today I'm joined by Zain Jaffer, who is the founder and CEO of Zain Ventures. Welcome to the show today.
Thank you for having me on.
So Zain, tell us a little bit about yourself.
Yeah, so you can tell by my accent that's sort of corrupted now. It sounds like American and English together, but I actually was born in the UK. My parents are immigrants from East Africa. So they came to the UK with no money. I grew up in a pretty rough neighborhood, figured out how to operate a computer and build websites, and started building small startups. And eventually, fast forward, I built a startup that was acquired for 780 million. And then I wanted to make the world better, and I started figuring out how to invest my own money through my family office. It's been one hell of a journey, by the way. And yeah, I focused a lot on real estate particularly, but I invest across the entire spectrum like many family offices do.
So Zain, I want to go back to your kind of earlier childhood. You mentioned East Africa. Can you specify the region specifically?
Yeah, so there's a region called Uganda, and there was this dictator, Idi Amin, who basically wanted to do like ethnic cleansing or whatever it's called. And my parents had to flee because there were Indians who were living in East African region like Uganda. So they were taken as refugees to the UK, and then I was born in the UK.
Well, that is a horrifying experience for your parents, of course, but it's I think for audience it's so interesting because of the multicultural that's involved, but also this notion of ethnic cleansing. I mean, that's a very PC way of essentially saying genocide, right? I mean, that is an experience that I think most people would not be able to relate to. Are there any kind of stories or things you've heard from your parents where it kind of helped shape who you are and the way you look at or perceive the world?
Yeah, absolutely. And my mom and dad both come from different areas and backgrounds. My mom came from a more wealthy background, and there it was, they had unbelievable lifestyle, and they had monkeys and all these animals, right? And for them to suddenly leave all of that, and many people who stayed, they weren't able to get out, and they were killed, and the land was reclaimed and everything was taken back. But they came to the UK, and imagine how hard it is when you grow up with luxury. You come to another country as a refugee, not speaking the language. You're obviously subjected to racism as well. And you have to work hard on your own and make it yourself. And I think my parents' generation, being Indians who were in East Africa, became very risk averse. And growing up, there was a lot of pressure to follow a safe career path, to go to university, to get a safe, steady job. And I went to university, I got my master's degree, but I definitely didn't fit in with the corporate lifestyle. I knew I wanted to do my own thing and take risk. But I definitely felt a lot of people who came from East Africa, they were either extremely corporate or extremely entrepreneurial, and that's the case through my family too. And my dad's side, actually, they didn't come from luxury. They were much poorer. They all tended to become entrepreneurs. But my mom's side of the family, who came from a more wealthy background, became more corporate. Like every cousin I have, family member I have, has gone into corporate in some way or has a steady job,
Yeah, this is so fascinating. I think the reason I'm asking is it really helps shape kind of the archetype that you yourself end up becoming, but also personifying as well in some ways. But this notion of refugee, immigration, and then residency is interesting because generally when people immigrate, it's because they want to immigrate. Here it was very much out of necessity, out of survival, to escape ethnic cleansing. So the mindset is very different. I think immigrants that came because they want to come, there's a certain desire to assimilate, and I think there's a, I don't know, just an eagerness. I don't know if that's the right sense, but here it's kind of settling in, and there's a big discrepancy, like you said, between the lifestyle that they were accustomed to versus a lifestyle, and of course a new culture that they're kind of have to, adjust to very quickly. So this notion of risk aversion is really interesting because I wonder, how did you figure out that although you grew up in a certain culture that really valued risk moderation, let's say, realizing that there was this great potential to think about entrepreneurship. And when we think about entrepreneurship, of course, it's fairly broad in definition, but this notion of creating something out of nothing. You mentioned early on you sold Vungle, which was, I think, a MarTech mobile advertising entity that you sold. Can you tell us a little bit about that, and what was the impetus and the genesis of how that came about?
So back when I was a teenager and I was building websites, I was sticking ads all over the website, and I was making money by basically doing that. People clicking on ads. And when the mobile revolution started to happen, the big trend where people start using apps, I realized, well, why can't we put ads inside of an app? And why can't it be pretty? Why can't it be video? That was sort of what led me to create Vungle. And it was explosive, the growth. I got into an incubator in the US, and we just got LOIs from customers, and we had millions of dollars worth of pre-orders, and we raised a $2 million seed round. At the time, it was one of the largest seed rounds in Silicon Valley. Now, of course, people are raising way more for their early stage rounds. And then after that, we were heads down trying to build the product. And in the first year, we did 850K. Second year, 15 million. Third year, 56 million. Fourth year, 100 and something million. And it's just like this growth just didn't stop, just kept continuing and continuing. And it was very fun and very, exhilarating when you finally capture a trend. And when the trend takes off, I really understand now, especially as a VC, where invest in great teams in amazingly large markets, because eventually they'll figure it out, and they'll figure out how to really make it big. And even the number third and fourth and fifth company become unicorns, especially in our case. We definitely weren't the largest startup. There were other, one of my competitors is now public at a $40 billion valuation. We were the same size once upon a time. So that's the beauty in betting on big trends. And I think I was, very fortunate to have grew up the way I was in front of a computer, and sort of saw that trend moving to the mobile applications. And this was, 2011 timeframe.
Yeah, so I think one of the things that you're referring to is this notion of timing. I mean, at the early onset, I mean, let's say 2000, for example, when the dot-com was just kind of at its height, you had some things that were eventually going to be the likes of AdMob and various other things. But had you started the business in the 2000, it would have been probably a little bit too late, and the market wasn't quite ready. But by 2011, the ecosystem, the content was starting to really get built out. I think you had YouTube, and you could consume YouTube in mobility as well. So it was just the right time, and it very much, to your point, it's like this blue ocean. If you ride the wave, it's not about whether you're number one or number three, but as long as you're on the wave and you take that, and it's a tectonic shift, you're going to do well. And I think that's what it sounds like. So timing is really critical. I wonder, had you started, let's say, a little bit later, by, let's say, closer to the 2018 or so, it's a pretty saturated market now, correct? And I wonder if you kept in touch. You may also like our quarterly Ask Your Perkins event that brings some of the most notable experts and category-leading startups in their area of sustainability and human survival on Earth and in space. To register, visit askyourperkins.com/events.
Too difficult. I mean, you talked about AdMob, for example, and Omar Amoui, who founded AdMob, who's was a partner of Sequoia, and I don't know what he's up to recently, but he was very regretful that he sold AdMob so early, and he saw how Google butchered AdMob internally, and it became a massive business inside of Google. But he realized had he been independent, it could have been far bigger. And I tend to find that when an industry has such a bad reputation, because after AdMob, there was a string of just failure after failure. Companies in the marketing technology space just were going bankrupt. And there was some fraud issues with bot traffic on the web. And we were mixed into that. And we had nothing to do with that because we were mobile. We were applications. We didn't even have such a thing as cookies. And investors didn't get it. And investors were saying, we don't think you'll ever get to $1 million a year in revenue. And when we were doing $1 million a day in revenue, $1 million a day in revenue, like 7-8 years later, it was like, wow, how people were wrong. And I think it's the staying power. It's when there's a lack of funding, an entrepreneur has to really build a business for the long term. So we had to build a company and build it profitably. We were on track for $100 million plus EBITDA a year, before the transaction happened. And because no one wanted to buy us, because we couldn't get the right value, we had to keep building and building. And, one of our competitors I mentioned, who's now, $40 billion-ish market cap, AppLovin, they just held on and took the company public and got the right backers and grew, and I'm sure Vungle will go public too, under Blackstone, and probably, I think, will be at least $5 to $10 billion market cap. This is why you see today evergreen funds like Sequoia, who are now changing the VC model. Hold on to your winners. Don't sell. People, VCs especially, are too eager to liquidate an asset because they want to get the next fund raised and they want to show realized returns. But if you hold on and you really enjoy the company, you can build your dreams. I mean, forget $1 million a year, right? What if you're doing $1 million a day in profits? That's the stage that the companies are at now. So if you hang on and you're first in the market, or you're one of the first, you can build something huge. You just need the right investors behind you as well.
So we're going to come back to that because this notion of patient capital is something that we don't talk about enough, and it's so important. And I think the Sequoia strategy is interesting, but for a number of reasons. But we'll come back to that in just a second. So going from mobile and mobile apps and advertising to real estate, tell us about how that once you've established your family office, why focus on real estate?
Well, when you're a founder, you're working without a salary for many years. Your entire net worth is concentrated in one illiquid, highly volatile startup stock that you don't know. One day you feel like you're going to take over Google and you're going to crush them. And next day you realize these big ecosystem players can kill you and you're going to go bankrupt and lose all your money. And you're going to have to get a job, right? So I wanted the safety of real estate. And I saw a lot of people what looked like, that make easy money. They didn't have to be very actively involved. You could do some pretty cool things with loans and get leverage and use tax efficiency. And it felt like it's a good part of most family offices' portfolios. I just felt like, this is one area where I just want to learn about. I like the idea of cash flow. For someone who grew up with so little cash flow, who was constantly reinvesting and being hungry for all these years, I dreamed of this idea of cash flow. And I thought, what better way than real estate where you have some cash flow and potential appreciation?
Yeah, I love what I'm hearing this is, I think, the journey that you explained isn't incredibly unique in the sense that I think many, let's say, tech entrepreneurs that made it recognize the real value of diversification, not just in terms of the typical stocks and bond diversification, but asset allocation to others, including tangibles. Sure, you got the NFTs, but you also have the more tangible things that's generating cash flow, whether it's a parking lot, warehouse, industrial, commercial, mixed use, or whatnot. So in that regard, within real estate, and of course, it's a very diverse, unique set of challenges within each segment. Where are you focused?
I focus on the intersection between real estate and tech, which is PropTech. But how I got into real estate was I did everything. I was becoming an LP in multiple funds. I was doing opportunity zone projects. I was buying single family rentals, multi-family apartment buildings, self-storage facilities. just doing everything really, and realizing like, wow, everywhere I look, everything is archaic and broken. And there's very little healthy diversity. You know, there's a lot of old white money, generational wealth, and a lot of resistance to bringing in tech. So I felt like, okay, if the marketing technology industry I came from resulted in numerous unicorns, there are going to be a plethora of unicorns coming out of this intersection between real estate and technology, PropTech. And so I've paid a lot of focus there, and I also started a VC fund where we invest in PropTech startups, and that's what I spend my time doing. I buy real estate and I invest in PropTech startups, and then my family office, has a very, very diversified portfolio in all other regards, except we're very actively involved in real estate and startups.
Mm-hmm. So very interesting. Of course, real estate overall, it's a dynamic time frame in terms of what's happening out there in terms of landscape and trends. So it's interesting to hear, some of the mixes that you mentioned, multi-tenant tenant residencies to some of the industrial commercial aspects. Again, they're all changing, and it's so interesting. And then to your point, it is a very archaic industry, and many times it's not just simply lacking technology, but I think the family principles, or the ones that are in charge of some of these things, including those that are managing it, they're of a different generation. They're a different mindset. So I wonder, it's really more of a mindset change. And then, so even if you're back in the prop tech, how do you ensure that there's actually going to be adoption, assimilation into some of these markets?
Well, that's the beauty of buying real estate. And, I'm a partner at an institutional fund called Bluefield Capital. So when we invest in a startup, we have our own real estate we can test it out on, or we can do due diligence on, which is a lot less risky than investing in something and hoping that they can execute. When you have underlying real estate, when you understand the market yourself, this can fit. And it's not just, let's be charitable and help this startup. No, we have real estate. We have investors who buy the real estate, right, through us. We need to make sure that this technology actually impacts the real estate. Does it improve revenues? Does it reduce cost? Does it increase your profit, your NOI, your net operating income? If it does, then this startup's onto something, and we'll adopt it and pay for their technology all day long.
So this is beautiful, because I think this is where family offices really thrive. Is they take the family business and then make strategic investments that leverage and further amplify the business side. So to your point, you have essentially a test bed, which is a collection of real estate and access to that. And you're able to actually do real pilots and really be able to get quantifiable results in terms of the kind of NOI, IRR, and every other ratios that's important for those stakeholders. And then coming back to the patient capital side, again, real estate is one of those things where if you talk to German family offices that's been holding on to some of these marquee buildings, they've had it for not decades, but hundreds of years.
Generations.
Centuries. So how should we be thinking about patient capital in the context of not only prop tech, but also real estate?
Real estate is very slow, for sure. Risk and reward are two things that you always have to balance when you look at different assets. And I think, speaking as family office, right, I want to preserve my capital. A lot of entrepreneurs are like athletes or, celebrities who make a lot of money quickly and then blow it, right? And so I really wanted to diversify my family office portfolio. And that meant, scratching that itch where you want high returns and you want to invest in fun things and emerging asset classes, and investing in pure, simple cash flowing businesses. Apartments, people pay their rents. That's very easy to understand. But if you start going to commercial, especially in the world of COVID, right, a lot of risk there. And there's a lot more than just that, right? There's cloud kitchens, and there's, industrial warehouses, and there's all these exciting new use cases of real estate like co-living that are popping up. So you've got to balance. And I think you've got to look at your capital and realize, like, this part of my portfolio. So I look at, like, to dive in specifically, right? I started looking at real estate as an alternative to bonds and fixed income. Yield is very low. And I felt that, okay, if I can get some leverage and buy some real estate and get the cash flow in, I like that a lot more. And I like the impact we can have too. We're providing housing for people, a good environment. A lot of things I've done is also Section 8 workforce housing. There, people who wouldn't ordinarily qualify for housing, or people that, have a housing crisis, can at least live in some of the apartments that we own. So I do that. And then there's more risky things I'll do, like complete ground up construction and fun stuff too. And there's risk there. And that is definitely, like investing in a startup or investing in risky private equity. Not all real estate is equal, is what I'm saying.
Absolutely. Yeah. They all have different, risk reward characteristics and different asset classes. I think one of the areas that we want to touch upon is this notion of sustainability. And the challenge with those that hold real estate, the actual owners, operators, versus those that manage those properties, is that because they're many times, not always, of course, they're all very, very heterogeneous, but there's a resistance to change. And part of that resistance to change is show me that whatever you're bringing is going to really make a difference in terms of efficiency, performance, and let's say, cash flow operation. So in that regard, I wonder, where does sustainability fit in? Because I think, when people are presented with IoTs and data analytics and edge computing and new capabilities of that sort, first thing that goes up in the operator or manager's perspective is, what's this going to cost me, and what am I going to get back in terms of ROI? Is that really the case? And what are the kind of useful, practical use cases where it's actually being embraced and adopted that's actually helping to reduce carbon footprint from real estate and city centers? Don't forget to visit astroperkins.com to register for our next quarterly events. Past and current speakers include Damian Vaughn, former NFL player, Neil Gregory, Chief Thought Leadership Officer at the IFC World Bank, and many more. To register, visit astroperkins.com and click on Events.
This is so meaty as a topic to dive into. To break it down, you start with the fact that I worked hard for my money and I want to see my money be put to good uses. And I also want to make money from it, right? I've got my foundation, and that's very different how I manage my foundation money versus how I manage my family office money, right? So I thought, let's dive into the example of, Section 8 housing and deciding, we're not just going to go into multifamily real estate. We're going to go into workforce housing where some of the poorest people in America can live in some of the buildings, and we're going to try to make these buildings better. And so you want to make it sustainable. Well, what does that mean? And how do you make sure there's an ROI back? You're literally stepping on a minefield here now. What starts with a really good intention, like, I want to provide housing for some of America's poorest people, results in a whole barrage of ethical dilemmas that come up every single day. I'll give you an example, right? How do you handle the ethics behind this tenant's not paying rent? Do I evict them? Or what about a tenant that ordinarily wouldn't qualify for housing because they have bad credit? Shall I reduce my criteria for renting to people? What about criminal backgrounds or undocumented immigrants? And then, if you do that, then suddenly, okay, now there's a more risk profile. Maybe some banks aren't willing to lend me money anymore. Okay, now it's harder to make money from this asset. Well, you want to talk about the environment, right? Okay, do I want to bring in pest control? Do I want to spray pesticide everywhere? Do I want to spend more on higher quality roofing when there will never be an ROI on that? Because the tenants won't pay for it, right? So you go in thinking that you want sustainability in your portfolio, but when you actively manage it, you realize, wow, I have to commit to this fully. My IRR and investor expectations now need to change. And so you're always trying to figure out, well, what's the goal? I want to provide housing, but how far do I want to go? Suddenly now my family office is being run like a charity suddenly, which is absolutely not the goal. Right? Your goal is to make money. So you have to figure out these questions. And it's so much easier to passively invest in stocks and bonds and private equity funds where, there's all these great ESG ratings and you've got professionals who can look at stocks every day for you and figure it out. But if you want to go into real estate, you better figure out, what is it I want to do? In the ESG, what is it? Is it the environment? Is it the social good? What is it that I want to provide as a value here? And realizing that I'm going to have to draw the line somewhere. If you want to make money, at the end of the day, you do need ROI. And ROI does typically take a hit if you spend money on things that don't produce immediate cash back.
So you bring up really legitimate concerns and issues for investors and those that are holding property. And again, I think nothing to do with your property, but I think generally when it comes to multi-tenancy, there's a certain kind of let's call it a label maybe. And I hate to call out a specific name, but somebody's father-in-law who was in a White House not too long ago, his family owns many apartments throughout New Jersey, for example. And he is very much labeled as a slumlord because he refuses to invest into those buildings. And many times you will actually extort and allow for just this incredible penalty and interest that ends up occurring where they're perpetually stuck and paying this rent plus more and to these captive low-income people. So it's a tough situation, both sides, right? The tenants, but also those that are having to operate it. How do you manage that? And then to your point, where are the sustainability goals that make sense to target and realistically achieve?
So let's pick the first question for now. And how do you manage that? Well, the pandemic was a very tough situation because people couldn't pay their rents on time, let alone pay their rents. And the states were so slow, at least in America, to disperse help for tenants. And most states were very poor at distributing that, right? So you had landlords who have a mortgage to pay. I bought all my buildings with cash. So for me, it was a different scenario. I was very patient. But you have landlords who suddenly can't pay their mortgage, and their building's going to, go up for fire sale suddenly. So that was tough. I think the real answer is technology. I think there needs to be more fintech solutions, and we are investing actively in this through our VC fund. I'll give you an example of some innovations we're seeing, right? One thing I've seen is one of our breakout companies, Stake.rent. What they do is they give cash back to renters. Renters are not good with saving money. If you look at the average net worth of a renter compared to someone that owns a home, it is very heartbreaking. Once you're a renter, you pretty much stay a renter and you're stuck in this trap, this vicious cycle, right? And also renters are not good at paying their rent on time, and that can be bad for a property owner. Stake gives you cash back as you pay your rents on time, and they've found out that, wow, 84% of their customers now have more money saved in the app than they have in their own bank account. So that's one solution, that is changing the way America's renters rent, and they get rewards for paying their rent on time and saving money. The other one I've seen is, a lot of things around security deposits. There are laws changing now, thank God. Regulation is coming in that is requiring tenants to maybe, or landlords to accept security deposits over a period of time, maybe 3 months in some states, right? Rather than lump sum. Regulations on how much you can charge, transparency around the security deposit you get back. But that security deposit is a huge amount for some renters. And that security deposit is like their life saving. And if they don't get that back when they move out, that's heartbreaking. And how do they access that security deposit? We're looking at startups right now that are doing really innovative things around that, allowing you to tap into your security deposit to build credit. These renters don't have credit, for example, right? So they're stuck. And it's sad how society penalizes people who don't have wealth. Once you have a bad credit score and you miss some payments, you're in credit card debt. It's a vicious cycle, man, really vicious. And I think this is where there's good opportunity for PropTech. Look, to just sort of make another point here, okay? When I came into PropTech, I was frustrated with the amount of innovations I've seen built by rich engineers living in high-rise buildings, building technology for themselves. What about the rest of the world? What about people who are, only pay $500 a month in rent or even less? Who's building technology for them? Those people have landlords that are called slumlords, like you said, a lot of the times, where, the living conditions are atrocious and there's no reinvestment and it's just cash, squeeze them, and technology, I would love to see make an impact there. Unfortunately, I'm not seeing much PropTech opportunities there, and I'm patient there. I'm always looking to fund startups that do something to address the affordability crisis. I've invested in startups that do that, but we need to see more.
Yeah, so I think this is really important, this notion of affordability. I think the key is when it comes to some of these fintech, PropTech, is really understanding who the actual paying customer is. So is it the actual tenants? Is it the property owners or the managers? Or in many cases, is it the actual city or the county
Right.
that provides the vouchers or some subsidies, for example? It makes up the difference. I think that's really important, because in the case of true quote unquote slumlords, would they make any type of investments, even if it's a SaaS model? Probably not. So getting that model right is going to be important to getting the adoption and ultimately helping the underserved and underprivileged. We didn't get a chance to go over Musha Ventures, but if you could just real briefly talk about why are you investing into African emerging technologies when, at the onset of it, you were taught to be risk averse. And I think many people are choosing to invest primarily in North America and Europe, but why Africa?
When you have the privilege of running a family office, you want to see your money make an impact, and you want exposure to areas of the world and opportunities that you wouldn't otherwise be able to capture. And I really love the idea that Africa is where my parents came from, and the guy who started Musha Ventures, which is a rolling fund. Actually, it's the only rolling fund I've invested in. Everything else are pure venture funds, right? As an LP, you put a quarterly amount into the fund. And they invest in startups that are focused on deep infrastructure. A lot of fintech, actually, some health tech as well, payments and infrastructure. Africa needs a lot of infrastructure, and we got to wake up. 20 years from now, Africa is going to be one of the biggest opportunities we've ever seen. And that's where population growth is happening. And so I wanted exposure to that in my portfolio. I have a lot of traditional fund managers. I have a pretty vanilla diversification too in my family office, right? Where I have a certain percentage in fixed income and different types of stocks and private equity. And so I decided, I can't actively manage all of this. I'm just going to bring in great fund managers or fund of funds. And I'm going to focus on things I love. And I love real estate. I love startups. And I love a bit of private equity too. Fun opportunities. And that's where Musha Ventures fit into that. We also did something in a full cycle, which is a climate technology private equity fund. We've made a lot of investments into areas that we can't get traditional exposure to, and we need specialist operators who understand it. That's the sort of insight into how and why I did that.
Amazing. Well, our time is up, so let me go ahead and wrap it up here today. It's been a fantastic conversation. So I have been joined by Zain Jaffer, who is the CEO of Zain Ventures. Thank you for joining today.
Thank you so much.
If you've enjoyed this episode, take a moment to rate our show on any podcast platform that you listen to. Scroll down to the bottom and push 5 stars. It's that easy. And as always, thanks for listening.